Why does par whole life insurance matter again? Welcome to Question and Actuary, where you get answers to real questions. I'm Sharma of Taxevity Insurance, where we bring clarity to life and health insurance. Since the biggest life insurance companies in Canada are now publicly traded, their shareholders get 100% of the profits. With par whole life, they get as little as 2.5%. The par policy owners get between 90% and 97.5% of the profits from their par policies. Maybe that's why major insurers stopped selling par whole life after they became public. Sun Life exited in 2003 and Manulife followed in 2008. They're back. Sun returned in 2010 and Manulife in 2018. Why? Market demand for par whole life. Since the investment returns are smoothed, the dividend scale interest rate looks attractive during market downturns. Remember 2008? The downside is that par returns look poor when markets rebound and grow. Advisors have tended to sell whole life in bad markets and universal life during periods of prosperity. With par whole life, the insurer has discretion in how the dividends are calculated and distributed. The goal is to be equitable, but there will be winners and losers. Is the dividend you receive fair from your perspective? You have to trust the company. Can you? The interests of the insurer differ from yours, especially when shareholders own the company. Universal life insurance was developed to overcome the flaws in par whole life by offering guaranteed mortality rates, guaranteed expense loads, choice of investments, transparency, much like a bank account with monthly deductions. The death benefit options include one that pays out the face amount plus the investment account fund. If your face is $1 million and your fund is $200,000, the death benefit is $1.2 million with universal life. With whole life, who knows? Likely closer to $1 million. Par whole life policies do have a place. The reason is the current tax regime. New rules for life insurance were introduced on New Year's Day 2017. The consequence is that universal life insurance does not perform as well as before. You still have the flexibility and accountability, but you don't have as much capacity for tax sheltering. Also, leveraging strategies often work better with whole life insurance because banks will lend up to 90 or 95% of the cash value without requiring additional collateral. That's because the smoothed investment returns tend to be stable. With universal life insurance, the maximum loan is usually 75% of the cash value, up to 90% in very specific cases. Insurers have innovated. There are now non-par whole life products with smoothed investment returns like par whole life, guarantees like universal life, they're generally less flexibility. An example is BMO whole life insurance, which often works well for back-end leveraging. There is also non-par hybrid product categories. An example would be IA Equibuild with smoothed returns, investment flexibility, and guarantees. There's been a resurgence in par whole life insurance despite the enhancements to non-par products. Companies like Sun Life and Manulife have broad product ranges, offering both whole life, non-par whole life, and non-par universal life makes sense. Each product is tuned for different situations. Having choice allows advisors to pick the optimal solution for a particular client without choosing another insurer. Shareholders likely prefer non-par products because they get all the profits. However, if the market demands par whole life insurance, shareholders benefit from sales in that market too. That's because the par policyholders help cover the costs of running the insurance company. There's no perfect product for every scenario. There are certainly situations where whole life insurance deserves serious consideration, whether par or non-par. We routinely explore multiple solutions for our clients. Your thoughts? Feel free to leave your general comments or questions below. To discuss your specific situation in private, arrange a chat at taxevity.com.